All right. Thanks. Thanks again, Angela. Thanks, Ann. And most importantly, thank you all for taking some time to be with us today to go over an issue that all of us as investors have to deal with from time to time, and that is uncertainty. We talked about, or Angela brought up the idea of meeting your goals and saving and reaching those long-term financial goals. And I believe part of our ability to reach those goals is continuing to have or trying to hold on to a long-term focus. Now, many times that can be easier said than done, especially during periods of uncertainty. But that's why we wanted to bring this presentation to you today to help you gain a little bit of perspective on what's going on in the markets currently, as well as maybe help you prepare for future bouts of volatility or uncertainty in the market so that you can better withstand them, both from a financial standpoint, but also from an emotional and behavioral standpoint. So that's my goal for all of us today, is to walk away with a little bit more perspective on the way things have worked in the markets long term, but also with some perspective on how we may, as individuals, behave and emote when it comes to our money and our finances. So we're going to do that by looking at a number of different things. Like I said, we're going to start off by taking a step back and looking at the markets broadly. We'll also look at the tax landscape, since there's been some changes with that over this year. And then we'll spend the majority of our time looking at some longer term trends in the market and some things that each and every one of us can do, no matter where we're at in our careers, no matter how much we have in our retirement plan, no matter where we're at financially, things that all of us can do to, again, have that long-term focus or hold on to that long-term focus and do things that are going to help us move towards and track towards those long-term goals. All right. So as we get started, there we go. We have seen volatility in the market this year. So I want to take us back to February. And many of us may remember this chart or the feeling that this chart gave us in February, because as you will remember, in mid-February, there were a number of different things that were occurring in the market. There was talk of tariffs. There were reciprocal tariffs that were going on between the United States and China. There was weak economic data coming out saying that the economy was slowing down, that the confidence of us as consumers was decreasing. There were concerns about inflation. And because of all of this, we got to experience this chart here. We saw that between February 19th and April 8th, a relatively short period of time, we went on a relatively quick roller coaster ride down. And as you can see, the market, or the S&P 500 in this case, decreased in value by 18.9%. Now that put us into market correction territory. And as you can see, a correction is defined as a drop in the stock prices of 10% or greater from its most recent peak. So we were in a market correction, but like I said, this was a relatively quick market correction, because on April 9th, or April 8th, however you want to judge it, we started to see the market go in the opposite direction. And here you can see that between April 8th and July 28th, the market went from that low to a new all-time high. In fact, the market was up 28% through almost the end of July. And if you look at the market today, you can see that the S&P 500 was, I believe, trading at around 6,700 as of this morning. If we go from April 8th, where it was 49, 5,000 to today, the market is now up 34%, almost 35%. So what occurred was we went from a market correction to now a bull market in very short order. And that bull market, of course, is defined by when stock prices go up by 20% or more from their recent lows, which this, of course, is the chart that we want to see. But of course, this going back and forth between lows and highs can be somewhat disconcerting, and it can lead to some sort of uncertainty on our parts as investors. Now, I think what's important to think about or understand when it comes to the last two charts we saw is how long did these sorts of trends last? So this shows you the averages when it comes to market corrections, bear markets, and bull markets going back to 1928. And I think it's important to understand when we're in the midst of one of these types of markets, what we might experience. So you can see for market corrections, we've had 35 of those since the 28. Average decline is going to be 13.5%. More importantly than that, the question I always get from investors is, well, how long is this going to last? When we're in a market correction or a bear market, we want those things to last as shortly or as quickly as possible. So those last about 3.8 months. And you can see our most recent market correction was the one that we just saw on the previous slide. Bear markets, of course, are those drops of 20%. We've seen 22 of those since 1928. Of course, the average decline is going to be greater. The average time to recovery is unfortunately going to need to be greater. And you can see that was October of 22, the last time we saw that. As I mentioned, we're currently in a bull market. We've had 25 of those since 1928. Look at the average gain, 117%. These last almost 3 years. So this just gives us some context as to how long these things last and what we might be in store for. Averages are helpful, right? But every market is different. So we can't always lean on these numbers because they will change based on the market, based on where we're at in time, based on the economy, et cetera, et cetera. But like I said, I think it's always helpful to have these averages, to have these expectations in place so that you're able to prepare yourself both on the negative or the positive when it comes to your investments. The next thing that I think is important to answer for investors is, well, why is all of this happening, right? And there have been a number of different things that, of course, have happened over the course of this year that has led to this volatility, both in February and April, where the markets were going down, and since April with the markets going up. So as I mentioned, there's been tariff uncertainty. There's been worries about inflation. There were worries or concerns around what would happen with taxes in the United States. And we'll talk about the One Big Beautiful Bill and what it means for us as taxpayers here shortly. Those were things that were negative and brought on uncertainty. Along with that, we've got conflicts in Ukraine and Russia. We've got conflicts in the Middle East. We've got all those sorts of things going on. But on the other hand, and the things that have led to market gains since then is we've seen a massive investment in technology. We have seen investment in artificial intelligence increase steadily. We now have certainty on what taxes are going to look like for the next few years. So we have a number of positives in the economy that are occurring as well. Now, one thing that I want to double click on here is tariffs, because tariffs remain uncertain because we're not quite sure how this is going to shake out. We see announcements every so often on tariffs that may be put into place on certain countries or certain sectors. So you can see that, of course, tariffs can have a significant effect on the economy and on the returns of individual companies, and of course, on ourselves as investors. Historically speaking, tariffs are viewed as inflationary. Okay, so we'll have to see how they play out and how this affects the cost that we as investors and consumers pay at the grocery store or online or whatever it may be. From an investing standpoint, it will be interesting to see how this plays out both from a domestic and international standpoint. Tariffs typically or historically have been put in place to help protect or help domestic producers. So there could be domestic producer gains that we see from that. And as you can see from the slide, we believe that in many cases it could come down to individual companies and how they're able to deal with tariffs, the supply chains that they have in place in order to deal with those tariffs, as to how this is all going to affect us and the investments in our retirement accounts. So this gives you some ideas on some things to look at and watch. But again, this remains a bit uncertain, okay? Now, from that uncertainty, we move forward into something that is much more certain, because we now know what the tax situation or the tax laws are going to look like for the next several years for us as individuals through the passage of the One Big Beautiful Bill. So let me touch on a few of the provisions within this bill, which stretched, I believe, around 900 pages. If you're lucky enough, as I have been, to go through all of it, you'll know that there's a lot that we could gather from it. But let's talk about a few of the main things that are going to affect each, if not all of us, from the One Big Beautiful Bill. Because like I said, this really is going to guide us into how we save, how we spend, and what our tax situation is going to look like over the next several years. So first and foremost, the individual tax rates, those stay the same. All right. So we will see those same tax rates in place that we have seen over the last several years since 2017 with the Tax Cuts and Jobs Act. Another big change that we saw was state and local taxes. We will now be able to deduct up to $40,000 in state and local taxes. However, note that there are limitations to this based on your adjusted gross income. With all of these things, I think it's important to sit down with your financial advisor or your CPA or just your spouse and talk about how these things may affect you, okay? The last couple things that I'll mention on this page is the standard deduction. Notice that the standard deduction goes up by $750. If you are single, $1,500 if you're married. So this means that for many of us, if we're not itemizing on our taxes, we will have a higher standard deduction, which could lead to a lower overall tax bill for many of us. If you're over age 65, or if you know people that are over age 65, notice that last line item. Those individuals will have an extra bonus deduction that they'll be able to take advantage of $6,000 per person. There are adjusted gross income limitations on this, but for many people, that will be very helpful. You'll notice in that case, as well as others as we go through this, that there are time limits associated with a few of these. So that extra bonus deduction is only going to be available between 2025 and 2028. That goes for other provisions. The other thing that I think is important to make sure everybody is clear on with this tax bill is the term permanent. permanence has been thrown around quite a bit when it comes to this tax bill, and that many of the provisions are what legislators have called permanent. Now, that means that they're permanent only until a new tax bill is passed. Okay, so yes, these are the laws, and this is the tax code that we're going to deal with over the near future. But once we have new tax legislation, which I am pretty sure we will at some point in the future, they may change. Okay, so even though things may be called permanent, we may see changes in the future. Okay. A couple other things that I wanted to note here. Mortgage interest is one of our favorite deductions. All of us love to be able to deduct that from our taxes. No change there. So that is a good one. For those of us who have children, now our children are worth even more to us in that the child tax credit was increased to $2,200. So that is good to have. And then notice there are a number of changes when it comes to charitable giving that take place here for many people who are charitably inclined. So those are some of the key individual provisions. And I think for the most part, when we go to file our taxes at the end of the year or next April or sometime in between now and then, things will look relatively similar. Yes, there's a new higher standard deduction. There are a few other deductions which may bring down our overall tax bill. But I think when you go to fill out your taxes, things are going to function relatively similarly than they have over the past several years. I've included some business level provisions in this presentation. I don't know if they affect anyone on the line today, but those are things that affect businesses, may affect you as individuals, but do affect businesses from the standpoint of their earnings. So this could lead to investment gains based on how businesses use these deductions going forward. So I'll leave that simply there, but these are important to note from a business standpoint. One last thing that I wanted to touch on from a tax standpoint are some deduction unicorns, as I call them. And these are unicorns because in the past, there really wasn't much like them when it came to filling out our taxes. On the left-hand side of the page, you can see a mock-up of the Form 1040 and how it functions. You may remember that on line 11, we have our adjusted gross income. Then line 12 comes our standard deduction, which we touched on previously, or if you're able to itemize deduction, you would make that deduction there. And then on line 13, we had one deduction, which was for qualified business income. Now we're going to have 4 other deductions in that area. And these come to us based on some campaign promises that President Trump made specific to taxes on tips, taxes on overtime, and car loan interest. Okay. And you can see how those play out. The thing that I'll note here, and again, this may not affect any of us on the line today, but maybe it affects loved ones or friends of yours. With taxes on tips, taxes on overtime, this is a deduction that will lead to taxes on some tips and some overtime. This is not unlimited. As you can see, it's limited to $25,000 in each case. The other thing that I'll note here is the car loan interest. A couple things to note with this. Maximum deduction here is $10,000. And the thing to note is that this is for new car purchases only, not for used vehicles. Of course, in all of these cases, there are phase outs and limitations based on how much you make, how much you see on line 11 with your adjusted gross income. But for those who these affect, this could be very helpful. It could decrease one's overall taxable income. The last one that you'll see there is that charitable deduction for non-itemizers. In years past, Many people weren't able to deduct charitable deductions or charitable donations because they might have made too much or too little. Now, for everyone, we will be able to deduct up to $2,000 of cash donations that we make to our favorite charitable organizations, okay, even if you don't itemize, okay? So again, that should lead to overall decreases in what we see on line 15, our taxable income. One last thing that I want to note here is that these deductions will not affect one's adjusted gross income. And there are some very important things that work off of adjusted gross income. Our ability to make contributions to Roth accounts, for example. Some student loan issues work off of adjusted gross income. Taxation of Social Security benefits work off of adjusted gross income. So these things won't decrease our adjusted gross income, but they will probably decrease our taxable income. So overall, they should be helpful. Okay. If you have questions on those or anything else in the One Big Beautiful Bill, feel free to put those into the chat. We can take those questions at the end of our time together today. But as we finish up this section, I think overall, we've had a lot of change in the market, but hopefully this gives you an idea of why things have occurred and where we are going from here from a tax standpoint and from a market standpoint, okay? Next, let's talk about what we can really do as investors, all right? Because that's really the main thing that is important. Much of the uncertainty that we deal with as investors can lead to poor investment decisions, right? When we are uncertain, we become emotional. When we are emotional, whether it's investing or anything else, we can make quick decisions that can lead to poor outcomes, okay? So what we're going to touch on in this next section is going to be some data surrounding the market, all right? Now this data, I think, or I hope, provides you with some perspective on why it's important to simply start investing and continue investing, all right? Now, if we go back to one of the previous slides, we saw that the market's at new all-time highs. We see new all-time highs every day almost these days, right? And many of us who have been investing for a while, or even those who have started investing, may know of the adage of buy low and sell high, right? But what if we're at a new all-time high? Should we sell? What should we do, right? So this is some research that we did looking at new all-time highs in the market and what occurs once we're at new all-time highs. So as you can see, reaching all-time highs in the markets actually occurs relatively frequently, almost 22 times a year over the last 20 years. So this is something that we'll see continually over the course of this year and coming years. But more importantly, what happens in the market? What happens to returns in the market once we receive or reach that new all-time high? As you can see from that orange bar, what occurs is that momentum seems to carry the market upward. So as you can see, if we look at the 1 year, 3 year, or 5 year forward returns, or returns from those points, you can see that those are higher than all the other days in the market. All right. So this just shows that what is in motion continues to stay in motion, right? When it comes to the market as well as everything else in the physical world, right? So this is just one of those reasons or one of those charts that I hope leads you to step back and say, well, we're going to continue to move upward. Should probably just stay invested versus making any sort of drastic change in my allocation. Sometimes people might say, well, if I look at that chart on the right, Ben, I should really just try to invest on all the days that are all-time highs, right? But here we get into the difficulty of trying to time the market, right? We know that timing the market is pretty much impossible, right? People will, when they are emotional, step out of the market. And the reason that they do that is because of a number of different things, both behaviorally and financially. But here you can see just how important it is to keep our eyes on the prize. Stay focused on the long term. This chart just shows how one would have fared between 1999 and 2024 if they were continually invested or if they missed the 10, 20, 30, 40 best days in the market. And you can see that it is not close. All right. So staying invested is important. Trying to time the market is relatively or mostly impossible. So why try? The other thing to note here is that during those days when the market doesn't do well, which have happened, and I'm sorry to tell you, will happen in the future, many of us get emotional. We sell out. We change our allocation. This is a great picture of what really occurs in the market around those tough days. Even when the days are tough in the market, know that good days will follow, and they may follow very, very quickly. Here we can see the calendar of returns for the global financial crisis and the COVID crisis, and you can see that on those days when the market was down 2 to 12%, whatever it may be, a good day in the market was soon to follow. Okay. So it just really doesn't make sense to try to time the market and go in and out of the market, okay? Couple last pieces of data that I want to share with you. And this one is, I think, really great for all of us and for definitely you all today as participants within retirement plans. This is a great study that Morningstar did during 2020, which of course was the COVID crisis, and we saw a lot of volatility and negativity in the market. But what Morningstar did in this study was they looked at the behaviors of plan participants during a particularly tough time in the market. Here you can see they looked at the allocation decisions of over 600,000 401k participants. Over 40% of those were self-directors. Those were people who chose their investments, okay, which could be some of you in the audience today. What they looked at was what those self-directors did during this period of volatility. And as you can see, 13% made equity allocation changes by more than 5%, 16% had a greater than 5% chance or 5% shift in their account balance. The punchline to all of this is that those who made significant changes in their allocations underperformed those who did nothing by 7.5%, 750 basis points. So as you can see from the subtitle on the slide, during these periods of market volatility, it is probably best to simply keep your distance. Don't let the volatility in the market push you to do major changes in your overall allocation. One last picture that I want to show you, which really is just, the same story that I've been going over the last several slides, but I like to put these in different formats. Here you can see performance in the S&P 500, and you can see how the S&P 500 has performed over the years. I think going back to at least 1929 actually, and you can see that just from a performance standpoint, there are more years that are positive than negative, right? You can see that those years where there's positive returns of 0 to 10%, 10 to 20, 20 to 30, 30 to 40, et cetera, et cetera, et cetera, are greater than those that are negative. So I think here is a great representation of the fact that over the long term, Even though there may be volatility in the market tends to move upward. So we should simply stay invested, continue to make our deferrals, and ride the market upward. Okay. So hopefully that gives you a little perspective on the way the market has performed over the long term. All right. Now, while that is the case, I know that investing is emotional, right? Our money is an emotional topic. Our retirements are an emotional topic. So those charts that we just went through, yes, may be helpful. But even though they may be somewhat helpful, they don't, or they may not answer the emotional questions or the emotional issues that we are dealing with during periods of market volatility. So next, I want to talk about some behavioral ideas, some things that I hope will allow you to step back and pause and gain some perspective, even when things are volatile in the market. Okay. So here is another study that we at Janus Henderson did, looking at market volatility in 2022. And we asked the questions, how did investors behave during this period? And I think if we're able to understand how others behaved or how we behave during volatility, how we emote, the emotions that we feel during periods of volatility, well, this can help us recognize those emotions and recognize those behaviors in the future. Okay. So here we can see that market volatility that we saw in 2022. So how did investors behave? Well, we saw a couple of things specific to males and females. First off, when we looked at males, we saw that males during this period were more likely to feel overconfident. All right. There was an action bias that males had when it came to their investments. This led males during periods of volatility during 2022 to actually trade too excessively. Okay. Now, why did they feel this overconfidence? Well, they might have had more to lose. They may feel that they're experts in investing. They actually, in many cases, didn't seek support from a trusted professional or advisor. So this led to that overconfidence and their excessive trading. On the other hand, during this period of time, we saw that females felt underconfident. All right. This led them to invest too conservatively. All right. But even though there were different behaviors that each group had, the end result was the same because both groups underperformed, right? Either because there was that action bias from the standpoint of men, they traded too excessively, they tried to time the market, which we just saw doesn't work, or women who were invested too conservatively and weren't able to realize the gains once the markets went back up in value. So I think this is an important study because it may prompt all of us, whether we're men or women, to ask ourselves, do I feel overconfident, or do I need to reach out and ask for support during market volatility so I don't trade too excessively? Or do I need to review my asset allocation based on my age and my financial situation in order to take advantage of market gains? All right. So this, again, I think helps us understand through the behaviors of others how we may behave. One last thing that I want to talk about when it comes to behavior is some foundational research that was done when it came to investor behavior and how we as humans make decisions. And this is based on the research of Daniel Kahneman. If you're interested in this research, you can read his book, Thinking Fast and Slow. And what he and his research partner, Amos Tversky, showed us was that we as humans have two systems that we use to make decisions, System 1 and System 2. System 1, as you can see, operates automatically and quickly with little to no effort. So if I were to say 2 plus 2, everyone automatically knows that that is 4. 2 plus 2 is a System 1 problem. System 2, on the other hand, is the system that we use when we need to be more effortful, when we need to be more thoughtful, all right? So when we're filling out our taxes, that's a System 2 problem. Parallel parking, for some, is a System 2 problem. I admittedly am not the best parallel parker. And I get even worse at parallel parking when my wife is sitting next to me and telling me how poorly I'm doing at it. But that is a System 2 problem for me. Here's the problem. When we get emotional, when we become uncertainty, when we see volatility in the market, System 1 takes over. I think another System 2 problem that all of us have is our finances. I think we can all admit that we should be thoughtful and effortful and concentrate when we are making financial decisions. But when there is uncertainty, when we are emotional, what happens with humans is we provide a System 1 answer or a System 2 problem. And that is why people, and we've seen it through research, make poor decisions when it comes to their investments during periods of market volatility. So when you're feeling emotional, if you feel that pit in your stomach, right? Remember this and ask yourself, am I providing a System 1 solution for a System 2 problem? How can I step back and gain a little bit more perspective in order to tamp down on that emotion and make a better, more thoughtful decision? Okay, that's one thing that we can do to help create that almost pause that I think we need. Some other things that we can do come to financial planning. And all of these things, again, allow us to step back and gain that perspective in order to remember or remind ourselves of those long-term goals. So we've talked about some data through charts. We've talked about some behaviors and some things that we can think about mentally. Now let's talk about some things that all of us can do in order to increase financial confidence. I'm a big fan of increasing financial confidence because the more confident we are in our finances, the more likely we are to stick to our plans. All right. So how can we do that? Number of different ways. And these are things that each and every one of us can do no matter where we're at in our career or lives. First and foremost, a financial plan. Create or review your financial plan. As you can see, we did some research on this. 75% of respondents in a study we did, when we asked them, do you have a financial plan? If they said, no, I don't have a financial plan, that correlated with higher levels of negative stress. All right. So creating a financial plan is important. There are a number of ways you can create a financial plan. If you work with a financial planner, you may have a financial plan. Financial plans can look at specific areas of your life. That would be the modular financial plan, or they can look at your whole financial life, a comprehensive financial plan. But just sitting down and creating this provides clarity. It provides you that roadmap, right? Then when we reach periods of volatility or uncertainty, it's always great. It's important to find that financial plan, look at it, read through it, because that allows us to pause and remind ourselves of the things that we want to do, our long-term goals. All right. Reviewing or updating our financial goals. So within that financial plan, we probably have, or you probably have, a number of different goals. it's important during periods of volatility to review those goals. But even before reviewing those goals, we want to make sure that we are clear on the goals that we set. So how can we be as clear as possible when it comes to the goals that we set? Well, research has shown if we are provided with a menu of goals, and as we talked about, as Angela mentioned, you'll all get a copy of this. So you will have this menu of goals after the fact here. If we're able to review a menu of goals, people are much more concrete. They're much more clear on the goals that they want to have. Those concrete goals tend to stay in place for longer. Now, let me kind of explain why this is. If I give you this list of goals, you'll go through them one by one and you'll ask yourself, do I want to be better off than my peers? Yes or no? Do I want to pay for personal self-improvement? You'll sit down with your spouse and you'll ask them, you'll talk about them. Do we want to buy a house? Do we want to help our kids with college, et cetera, et cetera? You take some time to be thoughtful about them, right? On the other hand, if I were to sit down with you in a meeting as a financial planner and I were just to say, what are your financial goals? You may not have time to think about them. And by not being able to think about them, you come up with goals that aren't as concrete, that you may not be as sure about. I've asked you what your goals are. You feel the need that you need to tell me what your goals are. So you come up with the first thing that comes to your mind. So those goals are not as concrete as something like this. So being clear on your goals is incredibly important. And like I said, when we enter periods of volatility, stepping back and reviewing these goals reminds us of the goals that we have and the things that we are working towards. Cash and liquidity can be really important. Having an emergency savings account is incredibly important. I think COVID was one of those periods that reminded us of how important an emergency savings account was, right? But an emergency savings account can be really important because it not only allows you to deal with unexpected expenses, but if you have that money set aside, it means that you don't have to make any changes in your investment account in order to deal with those unexpected expenses. So figuring out what you want to have, the amount that you want to have in your emergency savings account is incredibly important. Now, the amount for me is different than it may be for Angela, or it may be different for Anne. And this is, again, one of those things where it's really important to take some time and think about this, right? Because we want to make sure that we have enough to where we're able to deal with unexpected expenses or deal with changes, but we don't want to have so much that we aren't able to invest for our long-term goals. So it is a balancing act that we have to conduct here, but it's an important balancing act because having that emergency savings account helps us deal with near-term issues, but also long-term goals. All right. Tax efficiency, of course, is important. We talked about taxes previously. Remember that we live on after-tax dollars. So if we are able to create tax alpha, as we might mention here, that can help us not only decrease our taxable income, but it may allow us to have some more assets to utilize in our day-to-day lives. So learning about utilizing tax loss harvesting is a great way to offset some of the income that you may have in a particular year. Many times people think about tax loss harvesting and they only do it at the end of the year. I think you can do it anytime during the year, excuse me. And it may be one of those things to review and think about when we have seen a drop in the market, okay? Roth conversions is another thing to think about when it comes to tax efficiency. And really, aside from Roth conversions, what I would encourage all of you to think about is how can you create tax diversification in your financial plans? How can you create a situation where you have tax deferred assets, tax free assets, and taxable assets, right? By creating this situation, you have assets that can be used over time that are going to have different tax treatments, all right? So many of you may be maxing out on the tax deferred side of your 401k. Are you able to create that tax efficiency through a Roth conversion or having another bucket of money? Okay, so that's just one of those things to think about. Maybe a little higher level tax planning there, but something to consider. Couple last ideas. Dollar cost averaging. Dollar cost averaging is really something that all of you are already doing in your retirement plan, but I think it's important to maybe step back and remind ourselves of what actually that is. Investing many times for people can be nerve-wracking, especially after a period of market volatility. While that is the case, we've talked about and we've seen reasons why it is important to continue to invest because the market continues to go up. But in this case, investing a lump sum of $12,000 may seem like too much. So how can we continue to invest, but do so in a way that actually feels less scary for us? Well, we can do it through dollar cost averaging. And what we do with dollar cost averaging is we take a lump sum investment, $12,000, and we split it up into smaller investments over time. So instead of $12,000 in 1 month, we invest $1,000 each month. And you can see based on the math, and if the market is moving upward, that this actually works out from a mathematical standpoint because we've invested the same amount, but we may actually end up with more shares at a lower average cost per share. All right. Again, as savers in a retirement plan, you are already doing this through your weekly or biweekly deferrals into your 401k or your 457 or whatever it may be. But this is just a nice graphic that shows you how this actually makes sense from a long-term financial standpoint. One last idea that I want to touch out is a bucketing approach. All right. And this kind of goes back to our cash idea. But a bucketing approach is really helpful. And it, as you can see, it can help us prepare for market shocks, especially when we're near retirement. The issue that many of us run into when it comes to investing is how do we invest a chunk of money for a long period of time, right? Let's say 30 years. How do we invest for a 30-year period? Well, like many things in life, it can become easier to figure that out if we break it into chunks or buckets. Another way that people talk about this is through the idea of time segmentation. Here's what I mean by this idea of a bucket approach. What we would do here is take our investment amount, right? It could be $100,000, it could be $1,000, whatever. What you're going to do is you're going to break that up into 3 pieces, and you're going to have 3 buckets based on different periods of time. As you can see in my example, in the first bucket, we'll think about the next 2 years or next year of expenses that we may have, and we'll allocate those dollars to that bucket, and those will be in cash, right? Then we'll think about years 3 through 10. And we'll take that chunk of money and we'll invest them in something that is going to grow, but is more conservative. So fixed income or bonds, for example. Lastly, we'll think about years 11 through 30, way off into the future. And we'll take that chunk of money and we'll put it into something that can grow over the long term, like stocks. All right. What this allows us to do is invest for a long period of time in a nice systematic approach. But more importantly than that, it helps us have a wonderful emotional check during periods of volatility. Because many times, as we've talked about in our time together today, when people become emotional, they make drastic changes in their overall allocation. This sort of setup allows you or helps you not have to do that, because you can say to yourself, or your advisor could say to you, there's no reason, Ben, to sell out of your stocks or your bonds, because we've set up this plan where we have cash available for you to meet your next 6 months, year, 24 months of expenses. What this allows me to do is step back and say, I don't need to do anything drastic. I continue to stay invested for the long term. I know I can meet my near-term needs when it comes to expenses. So I really love this approach because it allows us to invest for long-term goals, but also meet the short-term needs that we have. So let me go ahead and skip the last two slides and just finish with, I think, an important quote, right? When it comes to investing, right, you don't have to be smarter than the rest. You've just got to be more disciplined. I always remind people to start and don't stop when it comes to saving, when it comes to investing, when it comes to the good financial habits that we've talked about today, that you'll hear about through this series of events. So remember, just be disciplined. When you're feeling undisciplined, when you're feeling emotional, try to find something that's going to help you step back. Is it reviewing your financial planning? Is it reviewing your goals? Is it talking to your spouse, your financial advisor, whomever it may be? Find that thing that allows you to step back, pause, and remind yourself of those long-term goals, because as we saw in the beginning, or through that second section, if we stay invested, we're going to have those good gains in the market over the long term. So with that, I hope this has provided all of you with some ideas that you can utilize and discuss with your spouse, your significant other, some ideas on how the market performs over the long term, and most importantly, some behaviors that you can utilize when it comes to getting through market uncertainty, because we saw it earlier in the year. We will see it again in the future, but if we're able to stay disciplined, we'll be able to reach those long-term financial goals that we have. So with that, it looks like we did have a couple of questions come in.